The single biggest difference between a struggling agent and a producing agent is not the number of clients. It's the revenue per client. This training shows you how to calculate the real economics of every household you serve and why that one number changes every decision you make in this business. Most agents track the wrong thing. They count enrollments, they count applications submitted, they count appointments set. Those are activity numbers. They tell you how busy you were. They do not tell you how much money your business actually made. Revenue per client is a different kind of number. It tells you how valuable each household actually is to your business over time and what a year of your work is really worth. The fear underneath this is the same fear most agents have about any spreadsheet. You worry that if you actually do the math will tell you you've been undervaluing your time, leaving money on the table, and making decisions on instinct that you should have been making on data. That fear is correct. The math will tell you all of those things. But here's the good news. Once you see the numbers honestly, you can fix them. The agents who avoid the math stay stuck. The agents who run the math grow. Let's start with the foundation. Revenue per client is just the total commission you earn from one household across all the products they buy from you over the lifetime of the relationship. Not just the first sale, the whole picture. First year commission, plus renewals, plus any cross-sell products, plus referrals that come from that household. All of it. Here's why this number changes everything. If you only sell Medicare, your revenue per client is one number. Let's call it X. That number is fine, it pays the bills, but it caps your growth. To double your income, you have to double your client count, which means you have to double your lead generation, your appointments, your hours, and your stress. There is a ceiling, and you will hit it. Now look at what happens when you bundle. The same household that gave you X for the Medicare sale also buys a hospital indemnity plan. That adds another layer of commission. Add a final expense policy on top, another layer. Add a dental, vision, and hearing plan, another layer. Now refer the daughter for an ACA policy through a special enrollment period, another layer entirely. The same household, the same hour of your time can produce 2, 3, or 4 times the revenue of a single product sale. The math compounds in a second way too, renewals. Most insurance products pay renewals year after year, as long as the policy stays in force. So when you bundle on the front end, you're not just adding to this year's income, you're adding to next year's, and the year after that, and the year after that. A bundled household at year 5 is producing significantly more renewal income than a single product household at year 5, even though you wrote them in the same week. Let me give you a way to think about this without getting lost in carrier-specific numbers, because every carrier and every product line pays differently. Use this simple frame. Single product per household equals 1 unit of revenue. 2 products equals roughly 2 units. 3 products equals roughly 3 units. And referrals out of that household, when they convert, add even more on top. The exact dollar amounts vary by your carrier mix, but the pattern is universal. More products per household, more revenue per client, more income per hour worked. Now here's where the discipline of tracking matters. You cannot improve what you do not measure. So the first move is to actually calculate your current revenue per client, honestly. Most agents have never done this. They have a vague sense that they make decent money on Medicare, and they've never broken it down further. Don't be most agents. The calculation is simple. Take your total commission income for the last 12 months, divide it by the number of unique households you served in that period. Not policies, households. If you wrote a husband and wife on Medicare and a hospital indemnity for one of them, that's one household with 3 policies, not 3 clients. The number you get is your current revenue per client. Write it down. That number is your baseline. Every decision you make from here forward gets measured against whether it raises that number or doesn't. For most Medicare-focused agents who don't bundle, the revenue per client number tends to be modest. Not bad, but modest. The agents who run a real cross-sell process, who follow the framework on every household, who add ACA referrals from the family, often see revenue per client land at 2 or 3 times the single product baseline. Same client count, same hours. Different math? Now let me walk you through what this looks like in real numbers, using a simple illustration. Don't focus on the exact amounts, because your carrier mix will be different. Focus on the pattern. Imagine an agent who writes 100 Medicare households a year, single product per household. The first-year commission plus renewals over a 5-year period produces a certain total. Call that the baseline. It's a real income. It works, but it's a ceiling, because the only way to grow it is to write more households, and that means more leads, more appointments, more hours. Now imagine the same agent, same 100 households, but every household goes through a real cross-sell process. The Medicare policy goes in first. Then, on the bridge moment, 50 of those households add a hospital indemnity plan. 30 of those households add a final expense policy. 20 add a dental, vision, and hearing plan. And out of that book, 10 ACA referrals come from younger family members and convert to policies during a special enrollment period. Same 100 households, same number of appointments, roughly the same hours, but the total commission picture across the next 5 years is dramatically different, often 2 to 3 times the single product baseline. That is not a small change. That is a fundamentally different career. Here's the part most agents miss. The cost of getting that bigger number is small. The Medicare appointment was already on the calendar. The trust was already built. The bridge moment after the application was already there. All you did was ask the right questions in the right order. The marginal time cost of a real cross-sell process is about 15 to 20 minutes per household. The marginal revenue is enormous. There's a third layer that most agents never see, and it might be the biggest one: retention. Households with multiple products from the same agent stay with that agent at much higher rates than single product households. The reason is simple: multiple touch points, multiple renewals, multiple annual reviews, more reasons to call. The relationship gets stickier. Single product clients are easier for another agent to peel away. Bundled households are not. So, how do you actually use this in your weekly business? 3 rules. Rule 1, calculate your current revenue per client and write it down. Rule 2, pick a target. Most producing agents aim to grow that number by a defined percentage every year, not by adding more clients. Rule 3, every appointment, every week, every quarter, you ask yourself one question. Did the work I did this week move the average revenue per client up, or did it just add more single product sales to the bottom? That third question is the one that changes behavior. When you start measuring weekly progress against revenue per client, instead of just policy count, your decisions sharpen. You stop being satisfied with a Medicare-only enrollment. You start running the cross-sell process every time. You stop dropping the household after the first product. You start asking the bridge questions in every appointment. Here's a quick example of how this plays out in real life. 2 agents start the same year. Same lead source, same 80 appointments scheduled over 12 months. Agent A focuses on volume. She writes Medicare on every household, no cross-sell, and walks out. By year end, she has 80 single product clients and a respectable income. Agent B runs the cross-sell process on every appointment. She writes Medicare on the same 80 households, but her bundle attach rate adds an average of 1 extra product per household, plus a handful of ACA referrals from family members. By year end, Agent B has the same 80 primary clients, but her total commission income is meaningfully higher, her renewal book is significantly bigger, and her retention rate is going to outperform Agent A's by year 3. Same 80 households, same calendar, same hours, completely different 5-year trajectory. Here's your action step. Today, 2 things. First, calculate your current revenue per client. Total commissions over the last 12 months divided by total unique households served. Write that number down on an index card and put it where you sit during appointments. Second, set a target for the next 90 days. Pick 1 cross-sell product, just 1, and commit to running the bridge question on every primary enrollment for the next 3 months. At the end of 90 days, run the math again. The number will have moved. And once you've seen it move once, you will never run your business the old way again.